Pick the winning stocks and you'll get rich. That's the game, right? Seriously, how many times have you clicked on a video and heard a creator say something like, make money this week by investing in these top 3 stocks? Or here's the exact formula you need to follow if you want to get rich through investing. It's always about picking the right winning stocks and you'll get rich. But here's the thing, most of those videos will not tell you about the boring option, the option that quietly builds wealth over time and has helped more people become millionaires than all the hot stock picks combined. Today, we're talking about index funds and asking the big question, can you get rich through index funds? And if so, what does it really take to make that happen? Let's start with the basics. What are index funds and why does everyone talk about them like they're the safe bet in investing? In simple terms, an index fund is just a basket of stocks. Instead of trying to pick the next hot stock, an index fund buys a little piece of everything, usually based on a major index like the S&P 500, which tracks 500 of the largest companies in the United States. So when you invest in an index fund, you're basically saying, hey, I don't know which company is going to win big, but I do believe that over time the market as a whole will grow, and I want a piece of that. That's why index funds are so popular, especially for beginners. They're simple, low cost, and they spread your money out across a lot of different companies. You're not betting on one winner, you're betting on the system. But here's where a lot of people get stuck, because index funds don't make you rich overnight. And because of that, they feel slow. And that's where the temptation kicks in to start chasing those get rich quick stock tips that you see all over social media. And look, I get it. When you see someone say, here's how I made $10,000 in a week by picking the right stock, it's hard not to feel like you're missing out on something. But the truth is, most of those big gains come with big risks. And for every person who wins big, there's 100 who lost it all. That's why it's so important to focus on your trajectory, not your short-term results, which is what James Clear talks about in Atomic Habits. With index funds, your trajectory is slow, steady, and upwards over time. And that's exactly what you want if your goal is long-term wealth. Okay, so before we talk about the math behind building wealth with index funds, I want to pause for a moment and remind you of one important thing. Anytime you invest money, whether it's in an index fund, CDs, treasury bills, a brokerage account, or any other type of investment, there's always some level of risk involved. Returns are never guaranteed, and markets can go up or down. So before you invest, make sure you fully understand the risks and are comfortable with them. Only invest money you can afford to set aside, and always align your choices with your financial goals and your risk tolerance. With any investment, there's always a chance you could lose money invested. And I want to be clear, I am not a financial advisor. The information I'm sharing here is based on my personal experience and general knowledge. It's meant to inform and inspire, but not serve as personal financial advice. So if you have detailed questions or want guidance specific to your situation, you might want to consult with a licensed financial professional. So let's talk about the math behind building wealth with index funds. Because here's the thing, index funds aren't magic. They don't make you rich because there's some secret trick. They make you rich because of two simple but powerful forces: compound interest and time. Let me break it down for you. Historically, the S&P 500 has averaged about 10% return per year before inflation. If you want to be more conservative, many people use a 7% estimate to account for market ups and downs over time. That means if you stay consistent, reinvest your dividends, and don't panic sell when the market dips, you're looking at some pretty big numbers over time. In 10 years, that $500 a month could grow to over $5,000. In 20 years, it could grow to around $340,000. And in 30 years, you could be sitting on over $1 million from just $500 a month. That's the power of time and compound growth. Now, you might be saying 30 years, I don't want to wait 30 years to be a millionaire. And that's fair. But here's the thing, wealth building isn't a race. It's not about getting rich fast, it's about getting rich for sure. Many people never get there because they don't stick with it long enough. They get impatient, they stop contributing, or they try to shortcut the system by chasing risky trades. But if you can stay focused, stay consistent, and let time do its thing, that's how index funds quietly build wealth in the background. And remember, it's not about investing a ton of money all at once. It's about small, steady amounts over a long time. Or as they say, time in the market beats timing the market. And the other thing I hear quite often is, but what if I'm starting late? I don't have 30 years to wait for things to grow over time. And that's a valid concern. And the good news is it's never too late to start investing. You may just have to adjust your strategy a bit, focus on what you can control, and stay even more intentional with your money. Getting a late start and still being able to build real wealth is a big concern for a lot of people. And I think this topic deserves to be covered in more depth. So I'm going to be creating a video around this topic in an upcoming video. So you'll want to stick around for that one when it drops. So let's move on and talk about why most people don't get rich with index funds. And it's not because index funds don't work, it's because we just get in our own way. And I already briefly mentioned a couple of these, but let me give you a few real life examples of what tends to happen. First, people start and they stop. They get excited, they open an account, they throw in a little money, and well, life gets busy. Or they get discouraged by a market dip and they stop contributing. A year goes by, 5 years goes by, and they're barely building anything up. They have no momentum. Consistency matters way more than how much you invest up front. Second, people panic. The market drops, the headlines scream, recession, bear market, it's all crashing, everything's on fire. And instead of holding steady, they pull their money out. And here's what happens. By the time they feel safe enough to get back in, they've missed the rebound, which is exactly when the real wealth is made. Third, people get distracted. They start looking at crypto, penny stocks, and the latest next big thing and think, maybe this is my chance to get rich faster. So they jump around, they chase shiny objects, and they end up with a scattered portfolio, a lot of stress, and no real plan. But here's the thing. Even Warren Buffett, arguably the greatest investor of our time, says that for most people, the best bet is to keep it simple. Put 90% of your money in a low-cost S&P 500 index fund and 10% in short-term government bonds. If the Oracle of Omaha says an index fund is good enough for the average investor, that's a sign we should pay attention. But listen, and this is extremely important, index funds work, but only if you stick with them. The minute you try to outsmart the system, jump in and out, or chase the hot tip of the week, you lose the very advantage that makes index funds powerful in the first place. Remember that quote from Atomic Habits I mentioned? You should be far more concerned with your current trajectory than with your current results. Wealth building isn't about what your portfolio looks like today. It's about the path you're on and whether you're going to stay on it even when it gets boring or tough. That's the real difference between those who get rich through index funds and those who don't. So if index funds can make you rich, how do you actually do it? Well, it actually comes down to three simple things: consistency, time, and focus. Let's break that down. First, consistency. It's not about investing a huge amount of money once and hoping it grows. It's about investing small, steady amounts over time, whether it's $50 a month or $500 a month. What matters most is that you keep showing up month after month, year after year. Second, time. This is the secret sauce most people overlook. The real magic happens when you give your money time to grow. Decades, not days, because compound interest works like a snowball. It starts small, but over time it builds momentum like you didn't think was possible at first. Third, focus. This is where so many people mess up. They get impatient, they get distracted, they try to chase the hot trends. But real wealth building happens when you stay the course. Ignore the noise, don't jump in and out of the market, don't sell just because the headlines are scary. Don't try to time the market or guess which stock will beat the rest. Just stick with the plan. And remember, this isn't about being perfect. It's about staying in the game long enough to let the process work. If you can invest regularly, stay patient, and focus on the long term, index funds can absolutely build serious wealth over time. But it's not a get-rich-quick scheme. It's a get-rich-slowly but surely plan. And for most people, That's the most reliable path to financial freedom. Now, let's tackle the big question head on. Can you really get rich through index funds alone? And the answer is yes, but it depends on a few key things. First, it depends on how much you invest. If you're putting in $50 a month, yes, you'll grow wealth over time, but it's going to take a lot longer to hit that rich level than someone who can invest $500 or even $1,000 a month. Second, it depends on how long you stay invested. The longer your money has to grow, the more powerful compound interest becomes. So if you start young, great. But if you're starting later, you might need to invest more aggressively or for a longer period of time. And as I mentioned, we'll talk more about strategies for late starters in a future video. Third, it depends on your income and savings rate. Let's be real. If you're earning $30,000 a year, it's going to be a lot harder to invest large amounts compared to someone earning $60,000 to $80,000 a year. That's just math. But that doesn't mean it's impossible. It just means you have to adjust your expectations. Focus on what you can control. Take a slow and steady approach, or find ways to increase your income so you can invest more. The bottom line is index funds can absolutely make you rich, but it's not magic. It's not passive in the sense that you don't have to do anything. You have to be intentional. You have to invest regularly. You have to resist the temptation to panic sell when the market dips, and you have to stay patient enough to let the plan work. Index funds aren't the only way to build wealth, but for most people, they're the simplest, most accessible, and the most reliable way to do it. So if you're feeling overwhelmed by all the stock picking videos and hot investing tips out there, just take a deep breath, zoom out, and focus on the long game. It's not about beating the market, it's about staying in the market. And if you're ready to learn more about how to build wealth on a middle-class income, watch this video next.